members, if you remember very well, we were at the point where we were computing tax paid, and that was after we had adjusted for working capital elements and cash flow from operating activities. We talked about quite a number of things, and the most important thing, which I usually say, is for you to have the concept at hand, because they will not change. They will always be the same concepts. Once you have them at your fingertips, you will not panic and you will not be intimidated by any question that you'll meet, so long as it's testing on the same concept we've covered under this cash flow statement or sample question that we are doing. So once we have the format and up to where we reached, I told you that these two elements, tax paid and interest paid, tax and interest, you see I highlighted the paid word for both the two elements here. And these elements, you will always meet them. In any cash flow statement, you might get differences in the elements or the adjustments. From profit before tax, you will find in most cases, depreciation will never miss. So I would ask you to make sure you know the adjustment of depreciation, borrowing onto what we had explained yesterday, and why we are adding back some elements while deducting some elements. The logic, as I had said, is very simple. The logic, as I had explained yesterday, is very simple, and that is not about to change anytime soon. So long as IAS 7 is still standing, then the concepts that we've explained will remain the same. So I told you that cash flow from operating activities, these are cash flows which are primarily derived from the principal revenue producing activities of the entity or of the firm. Therefore, these cash flows generally will result from the transactions and other events that enter into the determination of the profit or loss. That's why these elements we adjusted under operating activities, we go and borrow them from the statement of profit or loss. And these are transactions that were used in determination of the profit or loss. So when we start from profit before tax, we literally check all those transactions that were adjusted from the sales or from the revenue, so that we try to correct it by checking on non-cash items. That's the adjustment that we were doing. We were adjusting the non-cash elements. What we mean by non-cash elements is those transactions that were recognized on accrual basis in our statement of profit or loss, but did not involve movement of money, did not involve either payment or receipt of actual money. That's why we call them non-cash. There was no cash received, there was no cash spent. That's why we adjust them on, or we adjust the profits using those transactions. Depreciation was charged as an expense. We adjust by adding back. Impairment was charged as an expense. We adjust by adding back. Amortization, the same, was charged as an expense on accrual basis. We adjust by adding it back. Interest income was recognized as an income on accrual basis in the preparation of the statement. So it must have exaggerated our profits. So what we do to correct our profits because it was recognized as an income, but there was no money received on the same. We had just by now deducting. It exaggerated. It overcasted our profit. So we correct by deducting. Gain on disposal was also recognized as a gain in our statement of profit or loss. So our profits were overcasted by the same amount. The adjustment we did was now to deduct it. It overcasted our profits, so we adjust by deducting. Finance cost or interest expense is usually charged as an expense in our income statement. To adjust, we add back. And I told you, finance cost will not miss in any cash flow question. Depreciation will not miss in any cash flow question. These others might change at one point or the other. You might not get them in all the questions. You'll get some of them, you will not get others. That notwithstanding, you need to know the adjustments relevant to any and all of those elements. Once you have that, you also remember the simple approach I gave on the adjustments for working capital elements. Members, I believe you still remember that. I told you it will be very good for you if you know the reasoning behind the movement in the current assets and current liabilities. Those are the working capital elements. It will be very good if you know the reasoning behind why inventories are moving from 330 in 2022 to 280 in 2023. But if you are struggling and or maybe if you are not sure of the reasoning behind it, I would ask you to embrace the approach I gave so that in these working capital elements, the asset side of it, the elements falling under current assets, in most cases, receivables and inventory. Employ the approach of pick the opening value. Opening value is the value that you get from the previous period. In our case, previous period is 2022. Current period is 2023. Pick the opening from the previous period. Do any adjustments to it. Then you compare with the figure that is closing the current year. Once you do that, you will be able to get the figure whether it will be an inflow or an outflow. If you have it as a bracket, it will tell you, or as a negative, it will tell you that it is an outflow. If it is positive, then it is an inflow. Alan is asking, what does the total of 312 on the cash flow represent? Alan, let me check the 312 you're talking about. These 312 represent cash flow before adjusting for working capital. Alan, 312 represents cash flow before adjusting for working capital. You can type it in. I did not type it in, but you can go ahead and do it. Cash flow before adjusting for working capital. Now, the reason why I did not type it in is because you must not write everything. No one will penalize you if you do not type any of such a title or such a subtotal because it is not necessary. But if you have time to make your statement look, more complete, you go ahead and type cash flow before adjustment for working capital. You can as well, after that, go ahead and say working capital adjustments. Then now you start your receivables, inventory, and payables. Then after that, you can go ahead and say cash flow after adjusting for working capital or cash flow after working capital adjustments. On my case, I used a cash from operations. It is the same thing because I've just told you operating cash flow from operating activities are cash flows from which are primarily derived from the principal revenue producing activities. So that's why at the end of it, it is cash from operations. It is from operating activities or principal revenue producing activities. I hope you've gotten it. Now, yes, Winnie, thank you. We also responded to Alan. So, members, I gave you that simple approach. On the liability side, which is payables, I told you, if you do not have the correct interpretation in the explanation part of the movement in payables, you went to the statement of financial position, then you saw the payables moving from 254 in 2022 to 424 in 2023. But you're struggling to understand why the increase. Could it be an inflow or could it be an outflow? You really don't understand it very well. Do not struggle. Do not struggle. Time is moving, the clock is ticking. You need to score the maximum and move on. If you are not very good in interpreting the movement and the difference, do not worry. Take the simple approach. Start with the closing figure. Then you compare with the opening figure plus adjustments, When we talk about adjustments, we are talking about the easier way to explain adjustments is on, for example, on current tax. I gave you an example where we already did the tax paid, right? So if I activate that tax paid, you will see I told you to treat tax and interest as liabilities. Think of them as liabilities. In this, my approach on adjusting for liability element in the working capital section, I will use the tax paid line to explain that concept because of the adjustment I want to explain here. Our payables did not have adjustment and our receivables did not have any adjustment. That's why I'm using tax to explain what an adjustment will mean in that case. So if we think of tax as a liability, of course tax is a liability, and I hope we all agree tax is always a liability. Interest is always a liability. Remember, interest you have to pay. That's why in our income statement or statement of profit or loss, we charge interest for the year. Whether we've paid or not paid, we have to charge it. It is a liability. It's an obligation that you have to meet. It is the cost of financing your operations. Tax is also a liability because you have to pay the taxman. According to the state law, you have to pay. Now, when we take that approach, I told you for liabilities, start with the closing. The closing is in cell B56. Let's go and look at cell B56. You will see I picked the closing liability for current tax, which is 58. After that, I compare. To compare means you just put a negative sign. And we are comparing with the opening liability. And the opening liability is in cell D56, which is this cell D56. You can see the opening liability falls under the column of 2022. Now, I wanted to explain this adjustment. Now, we have to adjust the opening in case there is an adjustment. And in most cases, when you talk about tax and when you talk about interest, there will always be adjustments. In some other instances, you will get adjustments for these working capital elements, but it is not always the case. So do not worry if there is no adjustment for the working capital elements, but remember, there will always be. It is a must. You underline that word, a must. You must adjust tax and interest because you must have tax charge for the year in the income statement. And again, you must have interest or finance cost charge for the year in your income statement. That's why that adjustment will be mandatory in all the cases if you meet a question on cash flow statement. So the adjustment here was the interest charge for the year. You look at our income statement and you see there was an income tax expense charge for the year, which was 64 million. I typed the 64 million because I didn't want somebody to get confused of the sign. I could have referred. I could have just simply come here and said minus 64. And the reason why I put minus is because this one is a negative, so that negative by negative would turn to positive. In other words, I'm adding what is in cell D56 to what is in cell C20. No, not C20, but C21. But because I didn't want somebody to ask why I'm deducting, instead I should be adding, then I went ahead and simply added manually, added manually what is in that cell, what is in that cell. So this was closing. Then we compare with the opening. Then I added manually 64 because of the difference in the sign. I didn't want somebody to get confused, but 64 is simply the income tax charge for the year. That is what I meant by adjustment. So I hope you have that now at the back of your mind, and you will always remember it. Now I'm seeing, okay, that's tax. All right. Hello. I hope we are on the same page. I was explaining what an adjustment is under tax, Now let's go and do the same under interest paid. We also think about interest as a liability. So we employ the same approach. In all these adjustments, you can opt to use T account, or you can opt to use direct adjustments the way we are doing. The choice is yours. Go with what is easier for you. So let's go ahead and do that interest paid together. Now, members, we just go and put an equal sign in that cell. Then, thinking of interest as a liability, we start with the closing balance. Closing liability of interest. Closing liability. Where do we get it? We get it in the balance sheet under liabilities. So let's all go to the liabilities section. And you will see that under current liabilities, there is interest payable. So we pick the closing liability of interest payable. Once we pick that, we compare. To compare, I told you, just put a negative sign, or just a minus, whichever way. Then I want to introduce a bracket because our opening balance has to be adjusted. I told you for tax and interest, adjustments are mandatory. So I will open a bracket and say, opening. What is the opening liability for interest? Opening liability is the one falling under the column of 2022, which is the previous year. Then we adjust it. We adjust it by recognizing any interest expense that was recognized or that was charged in the current financial year. Remember, the one under column 2022 was a liability brought forward from the previous period. So we must bring forward the liability that we already have from the previous period we did not pay. We brought it forward to the current year. We add it to what we are having as a liability for the current period, so that we have our total liability to pay at the end of the current year. And that's what we are comparing against the liability we are closing with the current year, so that we see how much of the total liability which we had have we paid. How much have we paid, and how much is still outstanding, which we already know. The outstanding amount is now 6 at the end of the current year. So we get the total liability, we compare with the closing liability to see how much we've paid out of it. So after picking the opening liability, we adjust by adding the interest charge for the current year. Where do we get it? From the income statement or from the statement of financial position. And we can all go and see there is finance cost of 14 million in our statement of profit or loss. So I will go and just pick it. Finance cost. I pick the 14 million like that. So after I pick the 14 million, I just close the bracket because that's all the adjustment we have. But members, in case you get a question in the additional information where an examiner is trying to bring you an element of some deferred tax, remember, I explained about the effect of deferred tax before we ended the yesterday's class. Deferred tax liability, you also have to recognize it when adjusting for tax. But on interest paid, in case there is any accrued interest that was not recognized in the income statement, the examiner will be able to explain or maybe point it out in the additional information. So once that is pointed out, make sure you go and do that adjustment accordingly. But without a mention of that, this one adjustment is always enough. Once you do that, just confirm by clicking on enter, and you'll be having your interest paid there. In case there will be any adjustment, then we will go ahead and check on that adjustment and do it accordingly. Members, are we together? Confirm if we are together. Confirm if we are together. Members, are we together? Are we together? I want us to see and ask ourselves if there is any adjustment affecting
Excuse
those
me,
two
Mwalim.
elements. Yes.
There was a finance cost
Yes.
of 6 something. There was some interest paid of 6 shillings. Some finance cost of 6 shillings.
That's okay. That's what I was going to, so that we get to see if there is any other adjustment that we need to do. So, thank you. Who was that speaking? I didn't pick the name. Was that Mercy?
Yes.
All right. Thank you, Mercy, for that very good reminder. So, I believe that must have been from the additional informations. That's why additional informations are always good to check. Now, let's see. I think we had read additional information number 2. That's where we were able to get the gain or loss on disposals, then depreciation charge for the year. Good. I'm seeing note 3. Very good. Thank you, Mercy. Interest on finance leases of 6 million was included in the interest payable charged to the statement of profit or loss. So interest on finance leases of 6 million. So there was some 6 million included in the interest payable, which was charged to the statement of, to the statement of profit or loss that we have. So let's all go to the statement of profit or loss, and you see that the interest that was charged here, the interest that was charged of 14 million has an element of finance lease of 6 million. And I would want us to check this finance lease line, and we see what is the movement in the obligations under finance lease. I want us to see the movement in obligations under finance lease, obligations under finance lease. And before I go to check on the movement in the obligations of finance lease, I want somebody, even if it is Mercy who has reminded us of that, to tell us what is the impact of the finance lease, the 6 million here, the interest on finance lease of 6 million, which was included in the interest payable. What impact will it have on our interest paid? What impact will it have on our interest paid?
Well, at first,
yes,
I thought that it was part of the 14 million. That was my opinion. But when we did this question in the evening class, Mwalimu said that we had to add it to bring it.
You already did this question in the evening class, huh?
It was evening revision class. I just joined it.
Oh, okay. Yes. So how did you handle it?
We added it to the already existing finance cost, and so it brought it to 18 million.
What was the reason of adding? I want the explanation part of it.
For me, I was using the English. I was following the English that was saying it was included in the interest payable. So according to me, I was like, it was already there in the 14 million that we have in the we have in the income statement. He didn't give a proper explanation, but he just said that we do it and see if it will balance. And of course, when he added it, it balanced out. So I didn't have an argument.
All right. Thank you, Mercy. Somebody else? Winnie is saying, I think it's already included. Somebody else? Somebody having an opinion? Somebody having an opinion? Let me see. I'm seeing some chats here. Okay, Dorothy saying her thinking too. Eileen, I think we should deduct. Okay. This is interesting. This is interesting. All right. Members, I would want us to look at this together. You see, when we are told that interest on finance lease of 6 million was included in the interest payable charged to the statement of profit or loss. So you realize that when you have finance leases is a source of financing for companies. And when you have a lease, the interest on it is the cost of the lease, the cost of the lease. So if you look at the income statement and you see that in the income statement we have finance cost, which was 14 million, Now, we have to remind ourselves of the essence of this additional information. The essence of the additional information. Remember, an additional information is to remind you to do an adjustment. Additional information is to remind you to do an adjustment. So members, because we have to do adjustments, if there was no adjustment to be done, we would not have note 3 given under additional information. The examiner, once they have the statement of profit or loss, and there is finance cost given here, the examiner would simply leave it there because the finance cost is already shown and there is no adjustment required of it. Now, bringing on board note 3, the examiner is simply trying to tell you there is an adjustment that you need to do. There is an adjustment that we need to do. Although there are those instances where an additional information is brought, but it is simply for information purposes. It does not require you to do any adjustment. But I want us to remind ourselves that where do interest arise? Interest arises from, especially it arises expressly from the loan elements. Like now in our non-current liabilities, there is a 6% loan stock. This loan stock attracts interest to be paid every year. Now, interest expense arises from there directly. Again, we have another liability that is finance lease. So finance lease also attracts interest, the cost of lease. So if the examiner tells us that interest on finance lease of 6 million was included, this should be an adjustment. Using the word was included does not expressly mean it was already adjusted. Remember, these adjustments normally come after the statements have been prepared. These adjustments normally come after the statements have been prepared. In the additional information section, some of them are explanations of what has already happened. Very true. Some of them give you the adjustments that need to be effected. So this 6 million that arises from the interest on finance lease, the 6 million that arises from the interest on finance lease, is an adjustment we have to recognize. So when we come to the interest paid, in this approach of starting with a closing balance, then we adjust the opening balance. We must also adjust by recognizing the 6 million. We have to adjust by recognizing the 6 million, which is also an adjustment to recognize interest charged on the finance lease. That is how we need to do that adjustment. In case you have a different opinion, you are welcome to present it on board. I want us to do an adjustment on the finance lease so that we see how it plays. But finance lease will always come under financing activities. So we're going to see if the finance lease, the interest on finance lease was paid or not paid, because remember, finance lease is a loan itself. So as we look at loan repayments, we also have to check repayment on the finance lease, payments on the finance lease, whether there was a payment or no payment, or if they secured more finance lease to finance the operations. We are going to see that adjustment. Yes.
This statement is confusing. This one, though we've added, I don't object to that. But the statement itself, interest on finance lease of 6 million was included in the interest payable charged to the statement of profit or loss. If you check that English, to me, it's confusing because it's like included, it's part of that 14,000.
Thank you, Winnie. I agree. It is confusing. And what I normally do in such cases is very simple. You know what we do? I will highlight it, but leave it with that adjustment, because if there is a mistake, we are going to realize that the treatment that we did on note 3 was not correct. I don't object. It is confusing for sure. From the statement, is saying it's already charged to the statement of profit or loss. But my argument was it is an adjustment, because that's why it's been brought under additional information. So there is no worries. Let's just continue. I've highlighted it, meaning it is pending our final judgment. As we move forward, we're going to see if our treatment is correct or if it is wrong. So let's hold on to it at that point. All right. So after doing the tax and the interest paid, then we come to the cash flow from investing activities. Now, investing activities, members, I assume you already know that investing activities, these are activities, or these are cash flow from investing activities. These are cash flows that arise out of expenditures that will result in the movement of recognized assets in the statement of financial position. So when we talk about recognized assets, we mostly talk about the PPE elements or the fixed assets. The fixed assets, movement in fixed assets will always affect investing activities. That's why you see the elements we recognized here were purchase of PPE, proceeds on disposal, and elements like that. Now, I want us to just start doing the postings straight away, because we had done some adjustments. We had already realized there was some disposal. Remember the adjustment we did under operating activities. So with that knowledge, I want us to go ahead and do the adjustments. But to make it easy, I want us to do some simple PPE movement schedule here. And it is, I just want to do it beside here, not very far. So let's just, I want to just put it as a working here, just so that we see it very clearly. For PPE, because the investing activities are usually for PPE, I want us to look at it this way. You can opt to use the T account, but I will avoid the T accounts, because the T accounts might consume a lot of time. Now, this is an asset. PPE are assets. And to look at the movement in the assets account, we have to just, follow the treatment of assets, which we already know. And I want us to start with the opening balance. Opening balance is always on the debit side of the asset account. So opening balance in that asset account, let me just adjust that. So the opening balance, let us go to the statement of financial position and pick the opening balance on the PPE account. And if you look at this, the opening balance is the one under 2022, the 392. I pick that. Then onto the opening balance. What affects PPE? One of it, I think we had explained it in the previous question we did. PPE is affected by any purchase or any addition of any PPE element. Revaluation gain, if there is, on a PPE element. If there is disposal of any element or any part of PPE, then it will affect the PPE account. Depreciation also affects PPE. Then is there anything that I'm leaving out? I've talked about revaluation, I've talked about depreciation, disposal, and addition or purchases. I don't think there is something I'm leaving out affecting PPE, but if there is, members, you can always point it out so that we make sure we cover everything to completion. So after opening balance, I want us to check these elements that affect. Now let's start with addition. Was there any PPE element that was purchased? How do we know that? I know that if you follow the PPE account from the way it appears, you see in 2022, it was 392. But in 2023, it is 544. So it is highly likely that there were some additions of PPE elements. There were some additions on the PPE line. So to break this down, let's see addition informations if there will be any pointer to that. In note number what? Note number 2, there was a mention of PPE. Now, note 2 said, during the year, some of the items of PPE were bought. Now, this buying of the PPE element means these were additions, and they were bought under what? Under finance lease, and the amount was 56 million. So let's go ahead and recognize that purchase of PPE. So I will add it like addition or purchase. Addition stroke purchase. Addition stroke purchase, and it was from finance lease. There was a finance lease that led to the purchase or addition of PPE elements. And how much was it? They've talked about, was it 50 something? I've seen something, 50 something. Oh, yes, 56, good. 56 million. So we come and recognize 56 million like that. So this increases the PPE account value. Then we check on the other thing that affects PPE. Let's continue reading the additional information. Disposal of assets having a net book value of 38 million. So that is a disposal. And when checking on the movement in the PPE account, we have to effect this net book value, the net book value of the PPE disposed. This 38 million, we'll have to recognize it. Then, is there any other thing affecting PPE from the additional information? I'm not seeing. So first of all, let's recognize this, and let's recognize that disposal. Let's recognize the disposal of 38 million. So I will come here and say disposal, the disposal of PPE at net book value. And I remember seeing 38, is it? So disposal will reduce the value of PPE. Addition will increase the value of PPE. Yes, thank you, Elo. Depreciation is also an element. And before I pick on depreciation, which we computed, and I know we already have it, it was given expressly, yes, in note number 2, it was given, this 74 million. We have to recognize that. But before we do that, I want us to look at the income statement and see if there is any element that we can pick from there. If there is any element that we can pick from there to see if it has an impact. All right. So in the income statement, okay, interest income, there was no area of OCI. There was no OCI which was given. I believe you know what OCI normally records. OCI normally tells you if there is a revaluation gain or loss. And here, I want you to look at equity. Let's look at equity. Remember, these are final accounts that were prepared. So I want to look at equity elements. If there was revaluation, then it must affect revaluation reserve account. And I hope members you can see in 2022, revaluation was 0, revaluation reserve, meaning they did not open with any value. But at the end of the year, there was 14 million. You can see that, members. In 2023, there was 14 million. So that should tell us that there was some revaluation gain that was transferred to the revaluation reserve account. Revaluation affects PPE. So most likely, the PPE was revalued. So I will recognize revaluation gain, and the revaluation gain I'll recognize is 14 million. It increases the value of PPE. And I've picked that from the equity element of revaluation reserve account. The movement in that account tells us there must have been some revaluation. All right, then I would want us to look at this common element. The member there talked about depreciation. And depreciation was given at 74, and we know that depreciation reduces the value. I hope it is 74. I just want to confirm. Correct, it is 74. 74, and I believe we agree it reduces the value of PPE like that. Good. Any other element, any other adjustment? So we've done addition, purchase, disposal, devaluation, depreciation. Is there something we're leaving out? Is there an adjustment to PPE we are leaving out? Let me just check again. PPE there. I'm not seeing if we are forgetting something there. Additional informations we are done. I don't think there is something we are leaving, but you can check, members. You can check and let me know if we are missing out on something. I will use Alt equals to get this figure. Now, this figure that we are getting here, it is called what? We see, we started with the opening balance. These are adjustments. So if we adjust the opening balance, this is what we expect to close the current financial year. So expected, this is the expected closing net book value. Expected closing net book value. After we adjust the opening, recognize purchase, we recognize the disposal at net book value, gain on revaluation, then we also recognize the amount at which it depreciated. We should have an expected closing net book value. But is it the actual closing net book value? Where do we get the actual? We go to the balance sheet and see the actual closing amount is 544. Members, I hope you're able to see that. I hope we're able to see that. And you see the logic that we are following on PPE. It is the same logic that I told you to follow when we were adjusting for working capital. You see that element? We start with opening, then we do adjustments. Then we compare with what? Closing. It is the same thing we've done here. Opening, adjustments. Then we compare with the closing. We compare with the closing. So I would write here the actual closing net book value, which we are comparing it with. Opening, adjusted, then we compare with the closing. So what is the closing? The closing net book value is here as 544, given in the statement of financial position. You're able to see that. So that closing that we are comparing it with will tell us what must have happened if we expected the net book value to be 350. And we realized that the net book value is 544. What must have happened? Members, what must have happened? We expected to close at 350, but now we are seeing there they've given 544. What must have happened to make that value come like that? There must have been acquisition. There must have been more purchase or addition of PPE. Thank you, Elo. There must have been more purchase of the PPE element. So this one, the difference is likely to be purchase. There must have been some purchase of PPE, and the purchase amount would be the actual closing that we have compared with what we expected to be. So this 194 is the amount of purchase of PPE that must have happened during the year. I hope, members, you're understanding the adjustment. We just followed the same logic. The same logic. Opening, adjustments, compare with closing. So we are comparing this value of 350, which is the opening and adjustments. We are comparing it with the closing. The difference This represents what was purchased for PPE. So why don't we come to our purchase of PPE, purchase or acquisition of PPE, and recognize that value that we already have. We already have purchase of PPE, and purchase of PPE or acquisition of PPE, because when you buy, you spend money. So that purchase will come as a negative 194 like that. Members, I hope we are together. It will come as 194. Then, before we even go far, before we even go very far, I would want us to look at if there was any, we talked about, let me just talk about these proceeds on disposal of PPE. Proceeds on disposal of PPE. That was given in note number 2. Was it not 2 or not 1? Here, we were told that disposal of assets having a net book value of 38 realized 42 million. So you see 42 million we received. That was money. We sold and we got money. So proceeds on disposal, we got money, 42 million. And it is a positive because it is an inflow. So we recognize the 42 million. Then we ask ourselves, in the income statement, was there any investment incomes in the income statement? Was there any interest received? Was there any dividends received? If it is not stated in the additional informations, which I'm not seeing any mention of interest received, any dividends received, we check in the income statement to see, was there any interest received, any dividends received, and stuff like that. So if in that case, I want us to look at that in the income statement. I'm seeing interest income of 6 million, and I'm seeing interest income of 6 million. And I'm not seeing any other. Let me see. Dividends paid. So this is dividends paid. Remember, dividends paid. You pay dividends to your shareholders. So when we talk about investment, we don't recognize that investment, that the dividends under operating activities. We only recognize it in form of investment income received, not paid. If you talk about paid, now that is a financing activity, a final cash flow or affecting financing section. So when we look at that, so meaning these dividends, we are not touching on it. But members, I want you to remember, before we just speak on the interest income, I want us to go together and check if there is any interest receivable. What is the movement in the interest receivable account? Let's go to the balance sheet and see. Very good, it is here. You see, there is interest what? Interest receivable account. Now, if you look at it, in 2022, interest receivable was 4. In 2023, it is 2. So there is some movement in the interest receivable. What does the movement represent? What does the movement represent? So, because this is an asset account, being an asset account, we have to use the same treatment like I told you about. Let us start by the opening balance. Opening balance is 4, this one here, on the interest receivable account. Then onto the opening balance, we recognize any adjustment. And which adjustment are we talking about? If we opened with a receivable of 4, then income in the income statement, there is another recognition of interest income of 6 million. This is an adjustment to that opening. Then we compare that total with the closing interest receivable, which is 2. And we ask ourselves, if we opened with a receivable of 4, then we added 6, that is 10, and we are closing with 2. Why is the difference? What does the difference represent? There was a receivable of 10, and we are closing with 2. Now, from 10 to 2, the difference is 8 million. What does that 8 million represent? That's what we are going to follow up on. So if you expected to receive 10 million, that was the receivable. Debtors, Remember, receivable just means debtors. That's that which you expect to receive. Then at the end of the year, you realize that the balance that you expect to receive is only 2. What must have happened? You must have received the difference. That's why what you expect has reduced from 10 to 8. What you expected to receive has reduced from 10 to 8, meaning you must have received a part of it. Members, I hope we are getting that simple explanation. So under investment income, I do I use it as investment income, which will still be okay, but I can also just use the word interest income because it is interest receivable, interest income. So I would just, for example, just use interest income. Let me just use interest income because it states interest directly. So being an asset, interest receivable, I will start with the opening balance, like I said. Then I add the adjustments. Again, interest income account increased by 6 million. We expected to receive that. So in essence, we expected to receive this total. We expected to receive this total of this. Sorry, what did I add? The opening, which is 4, then add the 6 million, which is recognized in the income statement. We expected to receive 10 million, but we realized that at the end of the current year, the closing is given as what? The closing was given here as 2. So meaning we must have received the difference. We must have received the difference. So that's why it will come as a positive, an inflow. We received that money, an inflow. All right. All right, members. I hope we are together, members. Are we together? Just confirm as we move forward. I hope I'm not too fast. If I'm too fast, you let us know so that you don't remain behind. All right, right. Let me see. No one is still speaking, but please feel free to, if I'm forgetting something, you say it, you point it out. So I'm done with the interest income in the income statement and also interest receivable there. Something else, we've done the purchase and all that. Let me see. Purchase or acquisition of intangible assets. So we need to see if there was any purchase of intangible assets. And where do we get the intangible assets? Let's look at the financial position statement to see. PPE we are done. Now, members, I want us to look at these 2 accounts. And the 2 accounts is the account for financial assets at fair value through OCI and also the intangible assets account, intangible assets account. I want us to look at those 2 accounts and see what impact does the movements have. Now, look at this, financial assets at fair value. The opening balance in 2022 was 0, then it came to 190. What does that mean, members? What does that mean? In terms of cash flow? Somebody? What does that mean in terms of cash flow? What is your interpretation? All right, Elo is saying acquisition. Somebody having another opinion on the same? It opened with 0, but in the closing, at the end of the year 2023, the financial assets at fair value through OCI closed at 190. Members, this means they must have purchased. There must have been purchase of these financial assets. Yes, Stephen, thank you. This is an outflow. Because they purchased these financial assets at a tune of 190 million. So we come to this and we say purchase of financial assets at fair value. It is at fair value what? Let me see. Fair value through OCI. Purchase of financial assets at fair value through OCI. Let me just type it here. Purchase of financial assets at fair value through OCI, like that. Purchase of financial assets at fair value through OCI. And being a purchase, it means they spent money. How much did they spend? 190 million. So it's coming in as a negative. It's coming in as a negative. Members, any other adjustment I'm leaving out? Any other adjustment I'm leaving out? Any other adjustment I'm leaving out there? I want to see any other adjustment I'm leaving out. I want somebody to tell us something to do with intangible assets because it is here. Very good. This is interesting. Now, look at the opening balance in 2022. For intangible assets, it was 8. But then, at the end of the current year, the balance is 6. What must have happened in the intangible assets? What must have happened? And what impact does it have on our statements? What impact does it have? Thank you, iPhone. Thank you, iPhone. Amortization. Thank you. Somebody else having a different opinion? If you have a different opinion. Wilkista, disposal. Wilkista is saying disposal. All right. Wilkista is saying disposal. All right. Amortization, disposal. All right. Now, this is very interesting. And look at the element that we are talking about. We are talking about intangible asset. Now, in case there is disposal, I agree with Wilkista that disposal is also a possibility to reduce the value of intangible assets from 8 million to 6 million. I agree. But we do not assume disposal of assets if not given, if not expressly stated. We do not assume. And when you talk about, for example, intangible assets, we could assume disposal when talking about PPE. But when you come to intangible assets, if you are not told about disposal, you cannot expressly assume it. Look at the additional information. The disposal that we were given was only concerning the PPE elements, the PPE. There was no mention of disposal of intangible assets. So in that case, you remember the adjustments we did when we were dealing with operating cash flow from operating activities. You remember those? There is an element of amortization which we recognized. If I can just activate my formula, it will remind you that the amortization that we already adjusted was on intangible assets, Wilkista. I hope you had forgotten that. I know you had forgotten that. That's where we got the amortization. So it amortized from, amortization is the reduction in value of an intangible asset. So that was already taken care of. So that should not worry you. Once we did that adjustment, it does not affect anything to do with investment activities or investing activities. Yes, so Wilkista, I hope we are together. Now, members, that adjusts everything on investing activities unless I'm forgetting something. If I'm forgetting something, members, please feel free to say. And as you check if there is something left out, I want us to proceed to financing activities. Just give me a second or a minute. Give me a minute and look at the financing activities section. And from the word financing activities, I hope that we understand that these are cash flows that are arising from financing activities. And this revolves around sources of finance. If it is issue of shares, if it is payment to owners or maybe the shareholders to redeem their shares, if there is any cash proceeds that is realized on issue of, for example, debentures, on issue of loans, notes, bonds, mortgages, or any other short-term or long-term borrowings, whichever name they might give it, but so long as it is either short-term or long-term borrowings, any cash proceeds from that, from those activities are falling under financing activities. If there is any cash payment For example, on the amounts borrowed, then it will also fall under this activity. Then if there is any lease, remember, there is a mention of lease. If you look at our statement of financial position, you will realize that under non-current liabilities, we have loan, which is a source of finance, and again, we have lease. And we have lease as a non-current liability, and we also have current liability of lease obligation under lease finance. So I want us to look at the lease payments and see how much was paid for lease and things like that. So we want to look at that liability account. Being a liability, the approach is very simple. So I want us to trace and see, was there cash payment for lease or by a leasee to reduce the outstanding liability relating to that lease? Remember, lease is a source of finance. So there is liabilities that are related to the lease itself. So I want us to go and follow up on that lease. And how to follow up that lease, I want us to look at a short working here. Let's see how to do a short working here. Because it is an account, I want us to draw how to follow it up. So I don't know whether to call this working one or just working. But no one marks this really. This is just to help you in understanding. So I just want to try. I can just call it working 2, but really it's not. Whether we name it as a working what is not really very, very important. And the working 2 that I want us to look at is finance lease. Finance lease. I want us to see, was there any payment of finance lease or not? Was there payment or not? And as you have seen from the statement of financial position, our lease is falling under 2 categories. There is an current liability of lease, which is long-term, and there is a short-term lease obligation under finance lease falling under short-term liability. We have to marry them together, and I want you to borrow the knowledge of deferred tax and current tax. The treatment is the same. I told you about deferred tax. If deferred tax is there, it will fall under non-current liability. And again, current tax under current liability. The treatment is the same. So let us borrow that concept and do this lease thing. So to do the lease thing, following the same concept, we start at the opening balance. But being a liability, we can start at the closing balance. We can do everything in one cell. But because I want you to understand, I will not do everything in one cell. But I could simply come here and just click on one cell and do all the adjustments. But I want somebody to understand something here. First of all, let's go with this longer approach. We just start with the opening balance. But ideally, myself, I could start with closing. But let's start with the opening balance so that we see the movement and understand. Now, the opening balance that I would want us to pick is to go to the statement of financial position. It is opening balance of what? Opening balance of a liability. And the liabilities are in 2 sections. So we pick the opening non-current liability of finance, of the lease finance under 2022. This opening balance is 84. You see that opening balance. Then we also recognize opening balance under current liability on the same line of lease. Members, I hope you are getting it. This is the obligation, total obligation we are opening the period with. We are opening the period with a total obligation of 90 million. This is what we need to pay when we open the financial year. But during the year, we recognize any additional finance lease because it will also increase our obligation. Members, I hope you are getting that. This is the total liability we are opening the year with. We recognize any additional liability related to lease. And that's where I want to take you to note number 2. The note number 2, we were told very well that some items of PPE were bought under what? Under finance lease, amounting to 56 million. Meaning there was an additional lease obligation. And the additional lease obligation was to purchase some elements of PPE. Yes, and it a total of 56 million. So we say there additional PPE. Let me just leave it at that. I don't have to write so many things. And it is 56 million. Now, this was the opening liability. we've added more liability of 56 million. So the total liability we expect to pay or to have at the end of the financial year is 146 million. Total expected total closing liability. Expected total closing liability at the end of the year is 146 million. Members, I hope you are understanding that statement. This is the liability we expect to have in total at the end of the current financial year. But is it the case? Is it the case? We go and check in our actual closing balances that we have in the statement of financial position. So I will come here and say actual closing liability. Actual closing liability, so that we see if we expected the liability to be 146. There is some interference here. Somebody unmuted. There is some interference. I'm taking care of it. All right. All right. So there was this actual closing liability. We get it from the statement of financial position, and we also go together. They go together the same way deferred tax and current tax. I told you they go together. This is the same way we are also picking on this. So we pick on the closing liability for 2023 under non-current liabilities. We pick the 100. I hope I've picked the correct one, 100. Then we also pick the closing liability under current liabilities on the same line of lease. You see that 10, I pick that. So this is the actual closing liability. Now, we expected to have a liability of 146. But at the end of the year, we realize the liability we have is 110. What must have happened? We must have paid part of it. Part of it must have been paid because we opened with 90 million. We added more lease liability of 56. So at the end of the year, this company was to pay 146 million for lease liability. But we realized that when the year ends, this company is having a total lease liability of 110, meaning these guys must have paid some of this financial lease. So we call it repayment of finance lease. Repayment of finance lease. I hope you're understanding the reasoning that we have to arrive at the repayment. We expected to pay 146 to have as a liability total outstanding. But we realized that actually in the statement of financial position that ended the year, the actual balances is this 110 only. So the difference must have been paid. And what is the difference? It is what we expected, then we compare with the actual. So that difference of 36 million was actually paid, So we go to our financing activities section and we say repayment of finance lease, and we recognize the 36 million. Members, I hope we are moving on the same page. I hope. So we say, you see, this was a loan repayment, but we have another source of financing called lease. So that's why I cannot use the loan repayment line. Loan is different from finance, from lease. So I will just use the word repayment of finance lease, and I'm going to pick the same amount. Now, when you pay, it is an outflow. So I'm bringing it in as a negative. Now, if you had decided to use the approach of liability, which I had given you before, I gave you that approach when adjusting for working capital under payable, the same approach in tax and interest paid. If you could go and use the same approach here, it will still bring you the same value. I can do all that in one cell. What do? I start with the closing balance. The closing balance, I pick them from the statement here, 100 plus this 10. Then that after picking the closing balance, I just close this bracket and I compare the closing balance with the total opening plus adjustments. So I'll open another bracket and say, what was the opening liabilities? The opening liabilities were this 84 and the 6, right? 84 and 6. Then I do any adjustments to them. What is the adjustment? we secured or we bought more PPE on a finance lease. You see that 56? Then I add that 56 here. Then I close bracket and I hit on enter, and you realize that it is still giving me minus 36. Now you see. So go with the approach that is easier for you. I've given you both the two. You can go the reasoning way, the explanatory way, so that you understand the flow. You expected the liability to be this, but it is this, meaning we must have paid the difference. Or you can go the liability approach. Liability approach is pick the closing, compare or subtract, or you minus. The openings, you see the openings are two, the same way we treated tax, deferred tax plus current tax. Then this adjustment is any additional liability during the year. If you talk about tax, it is any tax that is charged for the year. You add it like that. This was an additional purchase of PPE on a lease. So this one increased our liability. If you compare that with the total of the closing, you will get the amount that was paid during the year. So you choose which approach is easier for you. I've given you both the two. So allow me to delete this after giving you that other way. So this one is meant to just save time for you. Now, members, I want us to look at any other element. Issue of shares. Was there issue of shares? The answer is yes. In note number 1, we were told during the year the company issued 10 million shares. You see that? There was that issue of shares, and that issue of shares will always affect financing activities. So I think having read that issue of shares, we should always now again remember on how to do the adjustments. What affects the issue of shares? I want us to go to the statement of financial position. For this case, we can still do a working, but I want to try and avoid working. Unless you insist, then I will do a working with an explanation like the one I've just done here. So you will choose. If you don't understand that approach that I'm going to give you the shorter one, I will go and do this breakdown. So please do not keep quiet if you are floating. Do not keep quiet if you are floating. Now, this is my approach. My approach again, the same way I've treated finance lease as a liability, I want to treat ordinary share capital as a liability. I'm the company. This ordinary share capital means I'm carrying the weight of shareholders. So to me as a company, I know this is equity.
Kindly mute Fasika. Mute your video.
Somebody has given us a video. Somebody wants us to watch some video. Vasca, please, but let me stop it for her. Maybe she started the video unknowingly, so it's okay. I think I've taken care of it. All right. So let's proceed. So now, I was explaining that there is another way, another approach that I want to employ on this ordinary share capital. And I was telling you that I'm the company. I know this is equity to me, and I know I'm also carrying the weight of shareholders. So to me, I would want to treat this ordinary share capital as a liability to me. Remember, I have to pay my shareholders dividends if I make profit. So to me, I will treat them as liabilities. I know they're my equity, but they're the shareholders, they're the owners. But to me, as a company, they are my liability. So I want to treat this account as a liability account. Members, that is my approach. I will give you yours if you want us to go the explanatory way. Now, my approach is that under issue of shares, we are dealing with ordinary share capital. I would write it in a bracket, ordinary share capital. Now, I will treat it as a liability. Now, on that cell, I put an equal sign, and I start with the closing balances. Where do I get it? I start with the closing balances because it is my liability. I go to the statement of financial position and pick the closing balances of ordinary share capital. Then onto it, I add share premium. Remember, guys, share premium goes hand in hand with ordinary share capital because premium arises when you issue shares at a price above the par value. So they are sisters. The same way deferred tax is a sister to current tax is the same way this share capital is a sister to share premium. Let them go together. It's the same way depreciation and accumulated depreciation go together. So there are those elements that will always move along together because one leads to the other. Issue of shares leads to share premium. Depreciation charge for the year adds on to the accumulated depreciation. So I would treat them as liability. So I add the two of them as the closing. Then after I add them as closing, I close that bracket like that. Then I ask myself, how do I compare that with the opening ordinary share capital account plus adjustments? So I have to open a bracket and compare that with the opening. What is the opening? It is the ordinary share capital of 220. Opening is the column of 2022. Then that goes together with the 70 of share premium. That gives the total of opening. Then onto that opening, I ask myself, was there an adjustment on the share capital account? Let's look at note number 2. Was it note 1? Note 1 to see what affected that account. We were told during the year, the company issued 10 million to par value ordinary shares at a price which was 100% above their par value. 100% above their par value. You look at that? Yes. So it was issued at a price which was 100% above their par value. So in any amount, if shares are sold at a price above the par value, then that should already tell you the shares were sold at a premium. Premium is that excess value which is above the par value. That is the premium on sales. So if we have the premium on sales, that is where share premium account arises. And before we recognize this issue of shares, you see this issue of shares of 10 million, before we recognize it, I want to take you to the share premium account. Look at the share premium account alone. Don't look at the ordinary share capital. Start by the share premium account. Opening was 70, and it has closed at how much? 88. Don't you see there was already an increase in the share premium account? I hope you are seeing that. Then I also want to tell you to look at the ordinary share capital line. Opening was 220 and it closed at 240. I hope you are also seeing that account increased from 220 to 240. Meaning what? In this case, because we've not been told about any transfer, any conversion of preference shares or debentures into ordinary, the only thing we've been told, or we've not also been told, if the policy of the company is to pay dividends in form of shares, then the only option we have is to know that this issue of shares was already recognized. The issue of shares was already recognized because we can see the account has already shifted, ordinary share capital and share premium. But I want us to look at the last part of that note 1. Incurring issue costs of how much? Of 2 million. Incurring issue costs of 2 million. So, our closing balances, this is the opening balances. But remember, there are issue costs that are involved. Issue costs that are involved. And before I go to issue costs, I would just close this bracket and hit an enter to see the movement in that share account. You see it is 38 million. We compare what started and the current that has closed. We realize that the ordinary share capital account has gone up from that value to this value, and the difference at which it has gone up with is 38 million, meaning 38 million was the cash that was raised on the issue of the shares. But remember, they've told us they also incurred some cost when issuing these shares. So we have to make sure we do not forget about the cost of the issue of the shares. And the issue of the shares that realized this 38 million has already been recognized. How did we know that? We knew that because of the movement in the share capital account. It moved from this to 20 to 240. Premium also, share premium also increased from 70 to 88, meaning the issue of the 100% above the par value was already recognized. The only thing that we have to also to make sure we check on is, was the issue cost recognized? The issue cost has not been recognized in this case. because we were not told if there is any category of expenses that already has taken care of the share issue cost under the major categories in this income statement. So what do? We have to recognize and take off the issue cost of these shares so that we say this amount we raised on issue of shares will less the 2 million that was incurred to raise that finance. Members, I hope we are together. That is my approach. Take the ordinary share capital as a liability. Start with the closing. Compare with the opening plus adjustment. In this case, the only adjustment we've done is to charge the issue cost. At the end of the total opening, we charge the total issue cost. You can as well break down that here. You can as well break it down. And if you don't mind, I can very fast go and break it down for you. And how do I break it down? I will just say ordinary share capital account, ordinary share capital account. And in the ordinary share capital account, let me call it working 3, but really these are aesthetics. No one will mark these ones even in an exam. So whenever you're doing this in an exam, know that you're wasting a lot of time, though your work will look very nice. But if you're sure you are scoring everything and you've already taken care of them, then you go ahead and do the aesthetics. All right. So I will just talk about opening balance of the ordinary share capital account. So the opening balance, remember, the opening balance is in 2 bits. We talk about opening balance of the ordinary share capital, and we talk about the opening balance of share premium. They go hand in hand. They go hand in hand. So I'm just doing this for somebody who wants to see it clearly apart from my approach here. But if you've already mastered my approach, please stick with it. It will save you big time. So ordinary share capital, opening balance, I will just pick the 220. Then for share premium, opening balance, I would go and pick the 70 like that. Then I ask myself, what are the things that normally affect the share capital account? What normally affects the share capital account? We know there is issue of shares, there is conversion of preference shares to ordinary, there is conversion of any loan element, for example, debentures to ordinary share, there is always payment of dividends in form of shares, there is rights issue, there is bonus issue. You remember all those things we had mentioned before. When we were preparing statement of changes in equity, I mentioned all of those and I explained. That's why I'm just rushing over them because we had covered them. So, without a mention of any of those elements here, of course, issue of shares has been mentioned, but I'm not going to the issue of shares. You know why? Because that one has already been reflected in the movement in this account, so I don't have to adjust anything. But again, remember, when raising finances, there is that issue of shares. And we've been told it was issued at a premium. And in the issue of shares, there is the issue cost that will affect the shares that we are issuing. And I remember it was 2 million that was incurred when raising the shares, when raising that finance. So if shares was issued and the issue of shares, actually we could have had an amount here to show us how much shares were issued. But because we don't have that, it was already reflected in the closing, the difference between closing and opening. I will just leave it at that. There is no problem. And I will use my alt equals to get the total of all this. And you see my total is 288. So if there is an opening, then I incur an issue cost of 2 million. I'm expecting the closing balance to be 288. This is the expected closing ordinary share capital account, 288. But if that is the expected closing, what is the actual closing? Actual closing ordinary share capital account. The actual closing, we come to the statement of financial position and pick ordinary share capital of 240. That is the closing column of 2023. And I also pick the share premium like that. I've not separated it the way I did in the first case, ordinary and share premium. I've just added the two of them. So there is no difference. There is no difference. In this case, I split. In this case, I've added them. There is no difference. So if we expected the closing to be 288, Yes, the closing to be 288, but the actual closing is 328. What must have happened? The amount that is actually closing is higher than what we expected. So meaning there must have been issue of shares, issue of shares, issue of shares. That brought in more money. That's why the share capital account shifted from 288 to 328. So the difference in which the share capital account has shifted now represents the amount that we must have received from that issue. I'm just wondering why the difference is coming to 40. If I adjust it to 38, this is now guesswork, and I don't want to go that route. Opening, we compare with closing, then we take care of the issue cost. I don't know why it is coming to 40. Members, what am I forgetting to put in here following the approach that I had given you here? I took the closings, the total closings, which is here. Unless I picked the wrong one, then I compared that with the total opening, then we deduct the issue cost. The total opening, we deduct the issue cost. I know the issue cost that I've brought in here has come at a point when it should not come, because issue cost will always reduce the amount you receive. Issue cost should reduce the amount you receive when you raise the finances. Because if you receive a total of 38 and you incur some issue cost of 2 million, if you raise finances and you receive 38 million and you incur issue cost on the same of 2 million, you realize 38, but the cost of getting that 38 is 2 million. Meaning what? Meaning you must have incurred 2 million so that the amount that you will eventually realize will come down to 36 million. So that explains it, and that makes it now easier to understand. So the issue cost should not come at this point. It should come at this point to affect the amount that we are raising. We realized 38, but out of it, we spent 2 million. So how much do we have left at hand? It is 36 million. It is the same 36 million that I got when using the first approach. So choose whichever approach is easier for you.
Excuse me, Mwalimu.
Yes, Mercy.
Umesema sasa because there was a movement in the ordinary share capital, now we
Yes.
are seeing the additional information one. Is this the case in all cases, or it's just in this question? Because if I was doing it without your guidance, would
Yes.
have added the share, the ordinary share that was issued in additional information one.
That is very good, Mercy. Thank you. And I want you to guide us because I want to use your approach and also do the same, and we compare and contrast. So Mercy, please carry on. Tell us, how do I start to recognize the issue? Let me go to note number 1. I want to do your workings here. Mercy, guide us. I want to type. Go ahead,
Okay.
Mercy.
I would have
Yes.
taken the opening balance of ordinary share capital.
Very
Which
good.
is
Opening
70.
balance, which is how much?
70.
Very good. I've picked 70.
And then we are told during the year, the company issued 10 million at 2 shillings per value ordinary shares.
Very
At
good.
a price that was 100% above their par value. So I would have taken the normal par value, that is 2 shillings. So
Very
it would
good.
make it 20.
Very good. The 2 shillings, then?
So 2 times 10 is 20.
Very good. 2 times 10 is actually 20. Very good.
Then I would compare it to the closing balance, that is 88.
So what does the 20 represent?
Additional ordinary shares.
Additional ordinary shares. Very good. Then?
And compare it to 88.
And we compare what? Compare 20 or compare the total of 70 and 20?
The total.
The total is 90. Very good. And then you compare with?
The closing balance is 88.
Very good. Closing balance is 88. Very good. So when we compare, what does the difference portend?
The 2 shillings, the 2 million, I don't know what it will show. But
Very
now,
good.
after that, I'd go to the share premium.
No, we are here closing balance and the 90. So the difference is 2. So what does the 2 represent?
I don't know what to call it, but it's like a loss because it's a reduction.
I will type it. Yes, it is a loss. Good. Then?
So on the share premium.
Yes, on the share premium.
Oh, no, sorry. I was taking the values for share premiums for the ordinary share. The ordinary shares are 220 and 240, not 70 and 9 and 88.
No worries. I will go back and pick 220. Then, does this still remain the same?
Yeah, the closing balance is 240.
Okay, then?
Closing balance, instead of 88, make it 240.
I make it 240. All right, I pick 240. Very good.
Then it means there was no issue of ordinary shares. The difference is 0.
The difference is 0. Good. So
the issue of ordinary shares is 0.
Issue
and then now,
of ordinary shares is 0. Yes.
So when I go to share premium, then I take opening is 70.
When you go to share premium, you will take opening, which is 70. Very good.
And then on the additional information one, we had 2 per value at 100%. So it's
Yes.
2. So share premium is 20 million again.
So share premium is 20 million. Okay.
And then we compare with the closing. The total, we compare with the closing, that is 88.
Closing, you are saying we go and pick the closing, which is 88. Good. So what is the difference
And
between
then
20 and 88?
we less the cost of 2.
So we less cost of how much? 2 million. Okay. So the opening 70, then do we add the 20?
Yes.
Then what do we do with 88?
We compare 88 with the 90.
We compare 88 with the 90. So this is 90. We
So it is
compare with the
90.
88. So the difference is?
The difference is 2.
The difference is 2. What does it represent?
I don't know what that is.
So we leave it hanging like that. Then now we less cost again. So this cost we less from 88.
From
So
whatever total we'll get there.
We'll get from where? From
it's also coming to 0.
It is also coming to 0. So from your tech, what now do we record?
I don't. That's why I'm asking you. Is this how do we handle it now? Every question will be assuming the issue, or what how will we be doing?
No. What I said, Mercy, was very simple. I didn't mention that we assume issue of shares. I remember very well, I said ordinary share capital account is affected by various factors. Movement in the ordinary share capital comes out of various factors. I'm not deleting this yours. Let me just put it there because you might say I'm biased. So I said, when you talk about ordinary share capital, this ordinary share capital movement can either be upwards or downwards. It's affected by issue of shares. When you issue shares, it will bring on board more shareholders, meaning ordinary share capital will go up. So there will be a positive impact on the ordinary share capital account. Then, whenever there is a bonus issue, bonus is issued onto the existing shareholders. For example, when the company makes extraordinary profits and they want to appreciate the shareholders or the owners, they issue bonus shares. These bonus shares that are given free of charge to the other existing shareholders will increase the ordinary share capital base. So the ordinary share capital will also increase upwards. Then, when there is a rights issue is also to existing shareholders, but it is an issue of shares at a price which is below the market value or the par value. So it is an advantage to existing shareholders. It's a rights issue. It also has an impact of increasing the ordinary share capital account. Then there is conversion. If there is any conversion of any element of share, like for example, preference shares being converted to ordinary, will always increase the ordinary share capital. Or conversion of any loan element or debentures to ordinary share capital, it will increase. Then if there is any what else am I leaving out? There is issue of shares, bonus issue. Now, in this issue of shares, this is where the premium comes in. When you issue shares at a price above its par value, then there is a share premium on top of it. So what I said is very simple. Given the language the examiner used in this question, and given what we can all see, remember, we were told during the year. I want you to see this, the way the statement started, and I want to highlight that statement because it is important. During the year, the company issued 10 million. Now, when it issued 10 million shares at 2 shillings per value, that is the par value of the shares, it was 2 shillings, and it was issued at a price which was 100% above their par value. And you realize that when you come to the statement that we are looking at the statement of financial position at the end of the current financial year. And this issue happened during the year. Now, the examiner has not expressly told us that the issue of shares was not recognized. And if we look at the movement of the ordinary share capital account, we already realize that having known the factors affecting ordinary share capital, we can be able to look at it and say, was the movement upwards or downwards? We can all see the movement was upwards. When the ordinary share capital line at par value was 220 to 240. What do you think might lead to the increase in the ordinary share capital account at par? This is essentially an issue or a conversion, an issue in terms of a rights issue at par, or a bonus issue. Without a mention of bonus, rights issue, or conversion, then that only remains there was an issue of ordinary shares at par. That's what made the difference, the share capital account to rise or to change from 220 to 240. On the same side, if we look at the share premium account, we are able to see again, it shifted from 70 to 88, an upward movement. Share premium only moves upwards if there is an issue at a premium. If there is an issue at a price which is above the par value. And in note 1, you are told, actually, there was an issue which was 100% above the par value. So that already explains why there is a movement in the share premium account. So if it already explains that, then it already tells us that this movement is actually because of that issue. Now, this examiner in this case only wanted us to point out and realize that there was a cost that was incurred in raising that finance. That's what the examiner wanted us to see. But given the language of the examiner, that is not always the case. They might bring that there was an issue, but the language they will use, or you will see that ordinary share capital account, if it had not been already recognized, you will see that the opening and closing of the ordinary share capital account is the same. Share premium, opening and closing would be the same, so that it is you to know that if there was an issue and you are told that it was not already recognized, or you are told that that issue happened, for example, at the end of the year, then you can be able to expressly see that it was not recognized here. So that's why I said we are not going to worry about what amount, maybe we are not going to again re-recognize that issue because we can all see it was already captured here. I don't know whether it makes sense, but I hope it does. I hope it does. So I want us to finish as you shoot any other questions to finish up. And I want us to see, was there any dividends paid, any loan that was acquired, and any dividends that was paid to NCI, or if there was any loan repayment? I want us to finalize this before time elapses, but I'm not shutting any questions. Feel free to shoot them, ask them, because we are here to make sure we understand. As we do that, I want us to just make sure these entries are done so that we finish together. Members, I hope we are together. Now, dividends. Was there any dividends that was paid? Let us check to see the income statement. And actually, I'm able to even see one here. We were told there was dividends that was paid. So in the statement of profit or loss, if we are told dividends without a mention of the word paid, meaning it was dividend proposed dividend, then members, you need to know a proposed dividend has not been paid. And if there is proposed dividend here or just dividend without the word paid, it should follow up with a liability to show dividend payable. You should see under current liabilities, dividend payable. But because it was expressly said or stated like dividend paid, then that's why in our current liability section, we do not have dividend payable. So let us pay this dividend because it was already expressly said dividend paid. So dividends paid, it is 40 million. And remember, because it was paid, it is an outflow. So we have to put it in as a negative. I hope we are together. Then when we talk about what did I want to talk about? The finance lease. This one we already finished. Yeah, that one we already finished. So check on the loan. Was there any loan that was acquired or was there any loan that was paid? I've not seen dividends paid to NCI. It was not mentioned in the income statement, and again in the additional informations, I've not heard or seen any NCI mention. So, but if there is, members, feel free. I've told you to feel free to, give your opinions. Now, was there any loan acquired or was there any loan paid? We might sometimes have both acquisition and repayment. We can have both of them at the same time, or we can either have an acquisition or a repayment. So both of them are valid. So let's just check on the loan account to see the movement in the loan account so that we get to see, was there a payment or was there an acquisition? Let's check on the loan account. Loan account under non-current liabilities. We're already done with the finance lease, so this one is already taken care of. I want us to check on the loan. Opening balance was 80. Closing is 40. Opening balance was 80 of the liability, but we have closed at a lower value. So what do you think must have led to the decrease in the value of the loan? Is it an acquisition or a repayment, members, in terms of cash flow? Is it an outflow or an inflow? Somebody very fast, somebody. I'm looking at the additional information to see if there is any mention of a loan, but I'm not seeing. All right, repayment, outflow. Thank you, members. I think I also share into the same. If the loan reduced from 80 to 40, then it must have been paid. Repayment of the loan is an outflow. So loan repayment is an outflow of 80. So I just want to refer to those cells. Where are those cells? It removed from 80 and then it went to 40. So that difference, we want to bring it in as an outflow. But again, we can choose to either start from closing. Being a liability, I like using the reasoning of a liability. Being a liability, it is normally easier to just pick the closing and compare with the opening so that it will always show it as an outflow when you pay. So I like picking it in the form of a liability like that, and you will see it is coming as a negative like that. Yes. So that is it. Was there loan acquisition? There could be a loan acquisition if the loan account shifted from a lower value to higher value, or if there was any information touching on loan. I've told you in one question there can be both acquisition and repayment. So be careful. Do not think that if there is one, the other one is automatically cancelled. No. That reduction in the loan account might also involve some repayment in between, and then they acquired even more loan. So you have to cancel out between what acquired and what was paid. and then get the overall effect. So I hope that makes sense. Good. Is there something you are leaving out under financing activities? Is there something you're leaving out under financing? As you look at that, help me check if there is something left. I want to start getting the subtotals here. The subtotals here. Let me just move this a bit so that I free up this column. I started by explaining to you why I went to the 2 column when drawing the cash flow statement. I started by explaining that. I hope you still remember. So I want to say the net cash flow from operating activities. What I'm doing, I'm just going back to get the totals. I've just gone back to get the totals. There is nothing much I'm doing, members. So do not think that there was something we left and I'm going to do it. Yes, we must have left it, but then there is really no cause of alarm. So the reason why, let me tell you the reason why I did not get the subtotals. My reason of not getting these subtotals, you see these ones, this one here and this one. My reasoning, normally in an exam situation, I encourage students that if you don't want to waste time with these things, you'll just remove them. And then when you come to the net cash flow, just get the total summation of everything. The net effect will be correct. But if you opt to go for the subtotals, remember, you will have to do what I'm doing here. You will have to come and pick on this. Then you will also come and I don't know whether this one was already taken care of. Let me check on the cash from operations. Yes, you see, the 312 was already taken care of. And the 312 already took care of what was above. So I will pick on this figure here and adjust this only so that I get the net effect. So I will do like that, get the cash from operations and then adjust like that to get that 444, to get that 444. I hope we are good. I hope we are good. Then I go again to cash flow from investing, and cash flow from investing, I want to do the same. I want to get the total net effect. Members, I've told you to check if there is something we are leaving out so that we do not really move when there is a pending case. I'm just getting the total net effect like this, and I'm having negative 334. Let me put it in bold. Then I go to financing, which we've just done. And let me also bring on board this here. And in financing, let me just retype this. Financing activities. In financing again, I do the same. I get my, I'm seeing I have negative 80 there from financing. I'm not seeing any charts, meaning you agree that everything is okay up to that point. Then we get the net changes in cash and cash equivalents. Net changes, or sometimes it's called what? Sometimes you can call it increase in cash and cash equivalents or decrease in cash and cash equivalents, whichever. Now, if you do not know whether it's an increase or a decrease, or don't want to go that direction, just talk about net changes. Because of course, if it is a positive, it's an increase. If it's a negative, it's a decrease. So I like using net changes, but you can as well go ahead and say if it is an increase or a decrease. So these are only 3 elements that I'm getting the net effect here. And I see it is 30. Of course, if it is positive like this, you are free to say increase in cash and cash equivalent. It is still okay. Whether you use net changes or you use increase, you are still good. You are still good. Okay. Lease paid, not yet considered. Nicholas, are you really sure? I remember very well that lease repayment is here and we did it together.
Excuse me, Molly. Excuse
Yes.
me.
Yes.
Please, may I see your totals from operating activities? Because mine is 952.
The total is here. I got 444. I got 444 with all the entries that we did. So you can check. I just want to get the final here, and then we clear any other differences that there might be. So if we have this net increase, so I'm tempted to just say net increase, though it is a net change, but it is obviously an increase because it's positive, net increase in cash and cash equivalents. Now, from there, from the net change in cash and cash equivalent, let us now see what was the cash and cash equivalent at the start, opening cash and cash equivalents. What was the opening cash and cash equivalent? Where do we get that from? We get that from the statement of financial position. We get that from the statement of financial position. So let's go to the statement of financial position. I normally just finish this thing directly. There are those teachers who normally decide to have a reconciliation, but I normally see reconciliation as a repetition of what we already have. So what I normally do, just go to the statement of financial position, pick on the cash in hand from the opening. Where is the opening? The opening is this one here, 2 at the 2022. Then we check if there was any overdraft facilities. For example, loan overdraft, and loan overdraft is here. I can see there was 40. That was the bank overdraft. There was 40 here. So the net effect is negative 38. You see that? Then that will give us closing cash and cash equivalents like that. So closing cash and cash equivalents is just the net effect of the increase and this one here. And the closing cash and cash equivalent, this one now we will compare and see if we are correct or we are wrong. Remember, there was something that we left hanging. You remember that thing? Profit? No. I highlighted something that we had left. This one, note 3. There were members who had a different opinion in note 3. We want to see if we are correct or we are wrong. You know, we are marking ourselves. Now, closing cash and cash equivalent, we are getting as negative 8. Let's confirm from the statement of financial position if the actual closing is negative 8. If it is the same, then we are all correct.
Excuse me,
Yes?
kindly repeat how you've done the opening cash and cash, both opening and closing, kindly, please.
So, opening cash and cash equivalent, I've just gone to the statement of financial position and picked the bank, the cash. You see cash in hand. If we had cash in hand, cash at bank, short-term, securities under current assets, you pick the openings. Openings is under 2022. So in this case, we only have cash at hand at 2. Then we have overdraft. You see bank overdraft? We less bank overdraft because it is also a cash and cash equivalent element. We know all the cash and cash equivalent elements, I believe so. So we deduct the bank overdraft because it's a liability. That's how I got negative 38. Then for closing, I've not checked, I've not confirmed from the balance sheet. I've just gotten closing from here. So I want us to confirm from the balance sheet if our closing is correct. So how do we confirm? Let's go to the balance sheet. I've put an equal sign. So to the balance sheet, pick the closing, which is under 2023. I hope you can see it is 8. Then we also compare with any cash and cash equivalent under current liabilities, and it is bank overdraft. You see bank overdraft? Bank overdraft is 16. So it is 8 minus 16. And from the balance sheet, I'm also getting closing cash and cash equivalent at negative 8. So meaning my figure here is correct. Our value here is correct. And that also tells us all the adjustments we've done are all correct. So for the member who had a different opinion here, in note 3, now your case can come in so that we confirm where was the problem. So I hope that makes sense. Now you can go ahead and ask the question.